Picture this. It is 1989 in Tokyo. The land surrounding the Imperial Palace is said to be worth more than the entire state of California. A single square meter in the Ginza district sells for nearly $500,000. Japanese corporations are buying global trophies the way children collect trading cards. Rockefeller Center, Columbia Pictures, Pebble Beach Golf Course. To the world, it looks like Japan has cracked the code of modern capitalism. Inside Japan, the mood is euphoric. The Nikkei stock index has multiplied nearly 4 times in just 6 years. Office workers check stock prices during lunch. Housewives speculate on real estate. Taxi drivers give investment advice. Everyone feels wealthy. Everyone feels brilliant. There is a quiet but widespread belief that this is not a bubble, but a permanent transformation. The future has arrived early, and it belongs to Japan. Then, almost without warning, the music stops. In a single year, Japanese stocks lose nearly 40% of their value. Land prices begin a long and relentless collapse. Banks that once seemed invincible quietly fail or are absorbed. What looked like unstoppable momentum turns into paralysis. Economists later give this era a sterile name, the lost decades, plural. Because one lost decade is not enough to describe what follows. 3 decades of stagnation. 3 decades of companies that should have failed but never quite died. 3 decades of an economy that keeps breathing but never truly lives. A slow economic zombification. And here is the part that should make you uncomfortable. The United States is now walking the same path. Not metaphorically, not approximately, but step by step, policy by policy, mistake by mistake. Most people do not see it. They assume history does not repeat itself at this scale. They believe Japan was unique, a cultural outlier, a special case. But the truth is far more disturbing. The mechanisms that trapped Japan are universal, and the United States has already activated most of them. When Japan's bubble burst, it was the second largest economy in the world. When the American bubble bursts, it will be the issuer of the global reserve currency. The consequences will not stay contained. They will not respect borders. This will not be a local event. It will be systemic. So we need to go back. Back before the crash. Back before the zombies. Because to understand what is coming, you have to understand how Japan got there. Japan's rise did not begin with excess. It began with discipline. After World War II, the country was devastated. Cities reduced to ash, industry dismantled, infrastructure destroyed. But through deliberate industrial policy, high domestic savings, a workforce shaped by social cohesion and long-term thinking, and a strategic alliance with the United States, Japan rebuilt itself faster than anyone expected. By the 1970s, Japanese cars dominated American highways. Japanese electronics filled living rooms around the world. Names like Toyota, Sony, Honda, Panasonic became synonymous with reliability and quality. Japan did not just grow, it earned trust. But the real turning point came in 1985, with an agreement few people outside economics remember, yet one that quietly reshaped the global financial system, the Plaza Accord. At a hotel in New York City, the 5 major economies of the time agreed that the United States dollar was too strong and the Japanese yen too weak. To correct global trade imbalances, they coordinated policies to weaken the dollar and strengthen the yen. On paper, it looked technical, almost boring. In reality, it was the spark. As the yen surged, Japanese exports became more expensive overnight. Growth slowed. The Bank of Japan panicked, and like many central banks before and after it, they reached for the same lever. Interest rates. They cut them, again and again, until money was almost free. Cheap money always tells the same story. When saving feels pointless, people speculate. When borrowing feels painless, risk disappears. In Japan, households borrowed to buy stocks. Corporations borrowed to buy land. Banks lent freely because rising asset prices masked every mistake. Between 1985 and 1989, land prices tripled. The stock market quadrupled. At the peak, the total value of Japanese real estate exceeded the value of all real estate in the United States combined. A country the size of California was, on paper, worth more than an entire continent. Golf club memberships traded for millions. Art prices shattered records. Tokyo became the symbol of limitless wealth. The world feared Japan would own the next century. Sound familiar? Because the same logic drove the United States after the global financial crisis of 2008, and again after the pandemic of 2020. After 2008, the Federal Reserve pushed interest rates to 0 and held them there for 7 years. Trillions of dollars were created through quantitative easing. After the pandemic, it happened again, only faster and larger. $5 trillion materialized to stabilize markets. The justification was always the same. Prevent collapse now, deal with consequences later. In Japan, the consequences arrived when the Bank of Japan finally reversed course. By 1989, it was clear asset prices had detached from reality, so rates were raised aggressively, from 2.5% to 6% in less than 2 years. That was enough. The Nikkei peaked in December 1989 and would not return to that level for more than 3 decades. Real estate prices declined for 15 consecutive years. This was not a sudden explosion. It was a slow deflation, like watching a structure decay from the inside. What followed is where Japan's story becomes truly important. The government did everything textbooks recommended. Rates were cut back to zero. Massive infrastructure spending rolled out. Banks were supported, money was printed, and none of it restored growth. Why? Because Japan had created something fundamentally new: companies that could not die. In a normal economy, unproductive firms fail. Their assets are redeployed, workers move on. It is painful, but it clears the system. Economists call this creative destruction. Japan stopped that process. Interest rates were so low that failing companies could borrow just enough to service old debt. They could not grow, they could not innovate, but they could survive. By the late 1990s, roughly 15% of Japanese firms were classified as zombies, alive in name only. These zombies did not just stagnate, they poisoned the system. They kept prices low, crowding out healthy competitors. They hoarded labor and capital. Banks, burdened with bad loans, pretended everything was fine rather than admit insolvency. Regulators looked away. Everyone played along. This is where Japan crossed the point of no return. And this is the point where the United States now stands dangerously close. After years of zero rates, cheap debt created the same conditions. By 2020, nearly 20% of large publicly traded American companies could not cover interest payments with earnings. Zombie firms, kept alive by policy. When rates rose in 2022 and 2023, many should have collapsed. Instead, credit was extended. Losses were deferred, exactly as Japan did. And the same distortions are visible everywhere. Housing prices detached from incomes, stock valuations divorced from productivity, faith that the central bank will always intervene. But there is one crucial difference. Japan could stagnate quietly, the United States cannot. And that is where this story becomes far darker. Japan, even at its peak, was still fundamentally an export-driven economy. Its companies sold cars, electronics, machinery to a growing world. Even as domestic demand weakened, firms like Toyota and Sony remained globally competitive. The country could stagnate internally while leaning on external demand. The United States does not have that luxury. America is not primarily an exporter. It is the consumer of last resort. It absorbs the world's excess production. It runs persistent trade deficits because the rest of the planet needs dollars. When an economy like that begins to zombify, there is no external engine to compensate. No one else can step in to buy what Americans stop buying. This is the trap the Federal Reserve now faces. If interest rates stay high to fight inflation, zombie companies fail. Commercial real estate collapses. Banks holding those loans absorb massive losses. We have already seen the early signs. Office buildings in major cities have lost 30 to 50% of their value compared to 2019. Regional banks have failed. 2023 was not an anomaly. It was a warning shot. But if rates are cut back to zero to save the system, inflation resurges. Savers are punished. The currency weakens. Asset bubbles inflate again. And the economy drifts into the same low growth, low productivity, zombie equilibrium that trapped Japan for 30 years. There is no painless option. Only delay or damage. So what does Japanification actually look like for people living inside it? First, wages stop growing. In Japan, average wages peaked in 1997 and did not recover for more than 20 years. An entire generation discovered that working harder no longer meant earning more. The social contract quietly broke. In the United States, inflation-adjusted wages for a large portion of the workforce have barely moved since the 1970s. The stagnation did not start tomorrow. It started decades ago. Second, opportunity narrows for the young. In Japan, zombie firms stopped hiring. They protected older workers and shut out newcomers. A generation drifted into unstable work, temporary contracts, delayed families. Look at millennials and Generation Z in the United States. Student debt, delayed home ownership, delayed children. Careers launched into crisis after crisis. The pattern is already visible. Third, assets stop being safe. In Japan, homes bought at the peak lost value for 15 years. Retirement savings evaporated. People worked into their 70s not by choice, but necessity. The American retirement system is even more exposed. 401k plans depend almost entirely on stock market performance. When markets fall and do not recover quickly, there is no backstop. Fourth, politics turns toxic. In a growing economy, compromise is possible. In a stagnant one, every debate becomes zero-sum. Japan saw rising isolation, despair, withdrawal. The phenomenon of people disappearing from public life, the United States is already there. Political polarization, deaths of despair, a sense that the system no longer works for most people. But what makes America's situation uniquely dangerous is not just stagnation. It is the dollar. When Japan zombified, the yen was just another currency. When the United States zombifies, the global reserve currency zombifies with it. The dollar's status allows the United States to print money and export inflation. It allows persistent deficits. It allows borrowing at low rates. This privilege reshaped the American economy. Manufacturing declined, finance expanded, speculation replaced production. But reserve currency status is not permanent. It rests on trust. The British pound once held the same position. After World War II, it did not. The transition wiped out decades of accumulated power. Britain had someone to hand leadership to. Who does America hand it to? China. That is not a routine transition. That is a geopolitical earthquake. Already, countries are preparing. Alternative payment systems. Central banks accumulating gold at record pace. Energy trades settling outside the dollar. Not because of ideology, but because of risk management. When confidence cracks, it will not look like Japan's slow deflation. It will look like a currency crisis. Imports spike in price. Inflation surges. The Federal Reserve faces an impossible choice. Defend the dollar with high rates and cause depression, or protect growth and destroy purchasing power. And behind it all sits the debt. More than $34 trillion deficits as far as projections can see. Interest payments already exceed defense spending. Soon, they will rival healthcare. Japan managed enormous debt because its citizens funded it internally. The United States relies increasingly on foreign buyers. If they step back, yields rise. If they sell, the math breaks. So, can this be avoided? In theory, yes. In practice, almost certainly not. Avoiding Japan's fate requires allowing failure, letting zombie companies die, forcing banks to recognize losses, accepting that asset prices must fall, restructuring debt, rebuilding productive capacity, making politically painful choices now to avoid economic ruin later. Japan delayed. The United States is delaying. Every incentive pushes leaders toward postponement, bailouts over restructuring, liquidity over reform, comfort over truth. This is not a conspiracy. No one planned it. Each decision made sense in isolation. But together, they built the everything bubble. .com. Housing, sovereign debt. Each crisis met with more extreme intervention, each recovery more fragile than the last. Now, there is no room left. The optimistic scenario is painful reform now and recovery later. The muddling scenario is decades of stagnation. The crisis scenario is collapse and forced restructuring. Even the best case involves pain. This is not about fear. It is about clarity. Japan thought it was different, that its system had outgrown economic laws. It was wrong. The United States believes the same thing today. The zombie trap does not close suddenly. It tightens slowly, quietly, until movement becomes impossible. The question is not whether the effects will be felt. They already are. The question is how long denial lasts and how much damage accumulates before reality is faced. Japan chose delay. It paid with 30 years. The clock is ticking. There is one final illusion that needs to be stripped away. The belief that this will somehow resolve itself, that innovation will save us automatically, that markets always heal if we simply wait long enough. Japan waited, decade after decade. Growth never returned in the way people expected, because the underlying structure was broken. A zombified economy cannot innovate its way out of decline. Zombie companies do not take risks. Zombie banks do not fund transformation. Zombie systems preserve what exists instead of building what is needed next. And this moment in history is not forgiving. Japan's lost decades unfolded during an era of global expansion. Trade was rising. Technology was accelerating. Demographics were favorable. Japan could afford to stagnate quietly while the world moved forward. The United States is entering its zombie phase at the worst possible time. Climate pressures are demanding massive investment and restructuring. Geopolitical tensions are forcing supply chains to shorten and harden. An aging population is increasing healthcare and pension costs. Trust in institutions is eroding. Democracy itself is under strain. A healthy economy struggles to meet these challenges. A zombified one cannot meet any of them. And yet, none of this was inevitable in the beginning. Every step along the way felt reasonable. Lower rates to prevent recession, bail out banks to stop panic, print money to stabilize markets, kick the can to buy time. Each decision solved an immediate problem while quietly worsening the long-term one. This is how traps work, not through malice. Through accumulation. The dot-com bubble became the housing bubble became the everything bubble. Each rescue distorted incentives further, each recovery required more extreme intervention. Now the system depends on those interventions to survive. So what happens next? There are only three paths. The first is reform. Painful, deliberate, politically unpopular reform. Let failures happen. Accept bankruptcies. Restructure banks. Allow asset prices to fall back to reality. Rebuild productive capacity instead of inflating paper wealth. This path hurts now, but it preserves the future. The probability is low. The second is stagnation. Rates drift lower again. Zombies remain alive. Growth stays weak. Wages stagnate. Inequality deepens. Society slowly hardens into a permanent low-energy state. This path feels stable day to day, but hollow over decades. This is the Japanese path. The third is crisis. Confidence breaks. Debt overwhelms policy. The currency weakens sharply. Inflation or deflation spirals out of control. Markets collapse. Social order strains. Restructuring is forced violently instead of chosen deliberately. This path is chaotic, but history suggests it is the most common. Even the best option involves sacrifice. There are no painless endings left. That is what decades of delay buy you. This is not about pessimism. It is about awareness. Most people equate rising stock prices with economic health. Low unemployment with stability. Central bank control with safety. Japan believed all of that in 1989. They believed they had engineered a superior model. They believed the rules had changed. They believed they were immune. They were wrong. The zombie trap does not announce itself with a crash at first. It arrives quietly. Growth slows. Risk disappears. Innovation fades. Life becomes more expensive while opportunity shrinks. People adjust their expectations downward without realizing it. By the time the trap is visible, escape is already difficult. The United States is not facing a sudden collapse tomorrow. It is facing something more insidious, a long narrowing of possibilities. What happens next depends on choices made now. Not someday, not after the next election, now. Japan chose comfort. It chose stability over restructuring. It chose delay over pain, and it paid with 30 years of lost momentum. The United States is standing at the same fork in the road. The clock is not paused. Time is the one thing zombie economies do not have. The trap is closing. Thanks for listening.